Hello, welcome to the fourth module of the course Economic Management and Policy Analysis, and we'll be looking at the fiscal policy and public finance, fiscal policy and public finance. And this module will actually explore how government raise and allocate resources to stabilize economies, stimulate growth, and also promote equity. And we will further look into it on the following heading. We talk about the government revenue, public expenditure management. We look at the budgeting process, the deficit and the debt management, and finally we look at the fiscal sustainability. And this we will briefly look one after the other. When we talk about fiscal policy and public finance, they are the cornerstone of economic management. And fiscal policy, being the deliberate use of taxation and public spending, is a powerful tool for stabilizing the economy, stimulating growth, and also promoting equity. On the other hand, public finance provides the structural framework for these policies, focusing on revenue generation, expenditure planning, debt management, and ensuring sustainability. And together, they reflect the government's priorities and its role in influencing economic activities. And also the challenge like fiscal deficit and rising debt highlight the need for sound management strategies that balances immediate development needs with long-term stability. And first, we'll look at the government revenue source. Government revenue source. And when we talk about government revenue, these are the funds a state generates in finance to finance its activities, products, and also provide public goods and services and support economic development. And it is the financial backbone of fiscal policy, ensuring government can fulfill obligations while promoting stability and growth. These sources include taxation, borrowing, and grants. And for taxation, this is most common and sustainable sources, and it's a compulsory transfer. It is compulsory transfer from individuals and business without direct or indirect return. It's a compulsory levy from either an individual or corporate organization, and it can be direct and it can also be indirect. It can be direct and also it can also be indirect. And for borrowing, it's used when other revenues are insufficient. It is used when other revenues are insufficient, and it helps finance budget deficits, infrastructure or emergencies. So borrowing helps to finance budgets, deficit, infrastructure, or emergencies. And grant is a non-repayable fund from foreign states, international organization, or donor agency, and often tied to specific projects. And these are the sources, revenue sources for governments. Talking about the public expenditure management, public expenditure management involves processes, policies, and system governance used to plan, allocate, and control spendings. And this ensures macroeconomic stability, efficient service delivery, and equitable resources distribution. And the objective of public expenditure management include directing funds to high priority sectors like education, health, and infrastructure. And this talks about the efficiency. And also another objective of public expenditure management is to ensure fiscal discipline. And this deals with the controlling spending to avoid unsustainable deficits or debts. Another objective is to ensure equity and fairness, that is, making sure that expenditure addresses social needs and reduces inequality. And also talk about another objective as ensuring accountability and transparency. Accountability and transparency. And this is making spending decision open, documented, and subject to oversight. What are the components of public expenditure management? The first one is expenditure planning, and this is identifying government priorities and aligning them with national development strategies. Another is the budget formulation, which is another component of public expenditure management, and this is translating priorities into a concrete financial plan, like annual budget linked policies with financial commitment. Another is the budget execution. After planning, you have to formulate, and the next is budget execution. And when we talk about budget execution, it's the practical implementation of the approved budget involving timely disbursement, transparent procurement, and adherence to regulation. And lastly, we talk about the monitoring and evaluation. After you've planned and you formulated budget formulation has been done, budget execution is being done, then there is need to monitor and evaluate what has been done. And at this point, you assess whether expenditure achieved intended results through performance indicator, audits, and also impact assessments. We move to budgeting process types. And before we talk about the types, the budgeting process translates government policies into financial terms and allocating resources to competing needs. And different approaches exist, each with unique methodology and implication. Through budgeting, government allocates limited resources to competing needs, ensuring that expenditure aligns with national objective. And different types of budgeting approach exist, each with its own methodology, advantage, and limitation. But those that are prominent or that we'll be talking about is the zero-based budgeting, performance budgeting, and incremental budgeting. When we talk about zero-based budgeting, this requires all departments to justify expenditure from scratch each cycle. And this promotes efficiency by eliminating wasteful spending. However, it is time consuming. And this talks about the aspect of its limitation, advantage, and limitation. The limitation is that it's time consuming, and the advantage is that it promotes efficiency by eliminating wasteful spending. And for performance budgeting, it links resources allocation to measurable results and outcome, and it enhances accountability by evaluating if funds achieve desired goal. This as an advantage, and as a limitation, data can be complex. Data can be complex. And then for incremental budgeting, this current budget are based on previous year's figure with adjustments, and this is actually simple and less time consuming. It's an advantage, and it has a limitation that it may perpetuate inefficiency. We move to understanding fiscal deficit. And when we talk about fiscal deficit, it occurs when a government total expenditure exceeds its total revenue, excluding borrowings, and within a fiscal year. It represents the financial gap that must be bridged, and we have three types of deficit. We have three types of deficit. We have the fiscal deficit, we have the revenue deficit, and we have the primary deficit. And just like we said, the fiscal deficit, the gap between total expenditure and total revenue, excluding borrowing. For revenue deficit is when revenue expenditure exceed revenue receipts, indicating capital receipts used for current consumption. And for the primary deficit, um, it's it is fiscal deficit minus interest payments and showing borrowing beyond servicing past debt. It is showing borrowings beyond servicing past debt, and causes of fiscal deficit are excessive public expenditure, revenue constraints in terms of weak tax administration, tax evasion, and dependency on volatile revenue sources. And another is economic shock, such as commodity price collapse, global recession, and some other ones. This can cause fiscal deficit. This can cause fiscal deficit. Looking at the debt management strategy, it involves strategies to finance deficits and manage debt sustainably, including decision on borrowing levels, debt structures, and repayment method. And some key strategies that are necessary to be put in place when we talk about debt management are: one, prudent borrowing, and this prioritize concessional loan for long-term return, avoiding unsustainable short-term debts. And another one is debt restructuring, and this talks about the repayment period, extending repayment period, or reducing interest burden for unsustainable debt levels. And also we have another strategy known as the domestic capital market, and this strengthens local bonds market to reduce vulnerability to external shock. Another strategy is the efficient debt servicing, and this ensure timely repayment of interest and principal to prevent default risk. And also we have the revenue mobilization, which um, deals with enhancing tax collection and broadening the tax base to reduce dependency on borrowing. Lastly, we will look into fiscal sustainability. Looking at fiscal sustainability, this is the government's ability to maintain current spendings, tax, and debt policy without jeopardizing long-term solvency or economic stability, and it ensures future obligation can be met without excessive borrowing or tax burden. And the determinants of fiscal sustainability include: one, the revenue capacity. Also, debt structure determines the fiscal sustainability. Also, the institutional factors, expenditure discipline, and economic growth. These are the determinants of fiscal sustainability. In conclusion, fiscal policy and public finance are essential for managing national economies, ensuring resources are raised, allocated, and utilized effectively to promote stability, equity, and long-term demand. So effective, we've been able to look at revenue mobilization. We've also been able to look at the expenditure management, the budgeting processes, the deficit and debt management, and fiscal sustainability. And effective fiscal management creates a solid foundation for prosperity and intergenerational equity. Thank you.